Welcome back, traders. It's great to have you all here on AM Trading. In this video, we're going to be diving into the world of smart money trading and learning how to trade like the big financial institutions, the banks. This is part of our Trading with the Banks series, Volume 2, where we'll be discussing the key principles of the smart money trading system that all traders need to know to become profitable. Now, as traders, we all want to be able to join the banks and trade like them. But what exactly does that mean? How can we learn from them and apply their strategies to our own trading? Well, that's exactly what we're going to be exploring in this video. We'll be taking a closer look at the trading strategy of large financial institutions like the banks and uncovering the key principles that they use to make profitable trades. So what are the main principles of a smart money trading system that every Forex trader needs to know? These principles form the basis of the trading strategy used by large financial institutions to make profitable trades. The main principles are order block, imbalance, break of structure, change of character, inefficiency, and liquidity. By understanding these principles, traders can gain valuable insights into the market and make better trades based on the actions of the smart money. Now let's take a closer look at the first principle of smart money trading, the order block. An order block is an optimized area of supply and demand that forms when banks or large financial institutions accumulate large quantities of their orders in a specific area. This accumulation causes a drastic movement in the market, leading to a significant price change. Order blocks form when there is an imbalance between sellers and buyers. As a result, the price rapidly pushes away from the order block because lots of orders are placed there. Order blocks are significant because they create an imbalance or inefficiency and break the structure of the market or change the character of the current market. Now let's move on to the second principle of a smart money trading system, imbalance. Imbalance is an area in the market where there are only buyers or only sellers, causing unequal market moves. This type of price action is considered unhealthy and inefficient since there is a lack of balance between buyers and sellers. An imbalance indicates a disequilibrium between buyers and sellers and represents unfilled price actions in the market. To understand the concept of an imbalance better, let's take a look at an example on the chart. As you can see, the market is showing an imbalance between buyers and sellers, causing a drastic movement in price. This movement is a clear indication that there is an imbalance in the market. The ability to identify an imbalance is crucial for any trader looking to trade like the big financial institutions. Once you can spot an imbalance, you can take advantage of it by entering a trade in the direction of the upcoming price move. Moving on to the next principle, we have the break of structure or BOS. BOS occurs when the price breaks a previous high or low, creating a new level of support or resistance. This pattern typically forms in the direction of the trend and can create continuation patterns, allowing traders to join the trend. In a bearish scenario, BOS forms when the price breaks a previous low. Conversely, in a bullish scenario, BOS forms when the price breaks the previous high. By identifying BOS, traders can gain valuable insights into the market and make better trades based on the direction of the trend. Now let's move on to the chart and see if you can identify BOS. As you can see in this strong uptrend, the price breaks the previous high, which we mark as a BOS. Same goes for the rest of the examples shown in this chart. Moving on to the next principle, we have the change of character or CHOCH. This occurs in a bearish scenario when the price breaks the previous high, and in a bullish scenario when the price breaks the previous low. Essentially, CHOCH refers to the fact that the market has changed through time. Identifying this change is crucial for traders to make the most out of their trading opportunities. Let's take a look at an example. In a downtrend, the price was not able to make a lower low, and finally it breaks its recent lower high, leading to a change of character. After the formation of a CHOCH, we will be looking for an opportunity to enter into a trade by using the order block. The same goes for an uptrend, where the price fails to make a higher high, breaks its recent higher low, and forms a change of character. Let's now move to the chart and see if you can identify CHOCH in the market. Here, we have a strong downtrend with momentum slowly weakening to the point where the price could not maintain its trend. Finally, the price breaks through its last low and forms a change of character. As we move along, it forms the order blocks, which allow us to place buy orders in the zone and wait for the price to activate our order. As you can see, the price activates one of our order blocks by reaching our optimized zone. Likewise, in this strong uptrend, the price fails to create a new higher high and starts to lose momentum, breaking its recent higher low, which eventually leads to a change in trend showing a change of character. As we go along, it forms the order blocks which allow us to place sell orders in those zones. Then we will wait for the price to activate our orders. As you can see, the order is activated right here. Now we move on to the next principle, which is inefficiency. Inefficiency in trading refers to a situation where there is a lack of buyers or sellers in the market, leading to an imbalance that needs to be filled. This can be seen in price action as gaps or spaces between candles, which are called inefficiencies. Inefficiencies tend to be filled eventually as the market seeks equilibrium. Let's take a look at an example of inefficiency in price action. On the left side of the chart, there is a gap between the candlesticks, which creates an inefficiency. This gap indicates a lack of buyers or sellers in the market and suggests that the market may eventually move to fill the gap. On the right side of the chart, there is no gap between the candlesticks, which indicates an efficient market where there is a balance between buyers and sellers. Now let's move on to the chart and try to spot inefficiencies and efficiencies in price action. As you can see in this example, there is a gap between the bullish candlesticks, indicating an inefficiency. This gap suggests a lack of buyers or sellers in the market and may signal that the market will eventually move to fill the gap. On the other hand, in this bullish move, there is no gap between the candlesticks, indicating an efficient market where buyers and sellers are in balance. The same principle applies to the rest of the chart examples. Now let's discuss the final principle, which is liquidity. Liquidity is the lifeblood of the market, as it refers to the amount of money or large counter orders needed to drive market movements. It is crucial to note that liquidity often accumulates behind dynamic trend lines or above below equal highs or lows, as this is where institutions typically place their orders. When the market breaks through these areas, it is often to gain access to the liquidity needed to propel its movements. In conclusion, understanding these 6 principles of price action trading can greatly enhance one's ability to identify profitable trading opportunities in the market. By carefully analyzing the market's behavior through the lens of these principles, traders can gain a deeper understanding of the market dynamics and use that knowledge to make informed trading decisions. Thank you for watching, and please don't forget to like and subscribe if you found this video helpful.